Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe. Click the bell so you get a notification of when we're releasing a new video. I'm sitting again today with Michael Porter. Hello, Michael.
Good morning, Rob.
We actually should be dressed in Bok jerseys, Michael, because
It is Bok Friday.
It's Bok Friday, and the questions over who is the best in the world are going to be answered over the next couple of weekends, I guess. But Michael, who is best in the world when it comes to debt is America. $40 trillion. They've hit a big number, haven't they?
I think that was on Wednesday that they hit the big number, 40 trillion. And obviously, is it in Times Square or there's a big ticker that sort of has how much debt they have. So yes, 40 trillion. Yeah.
So Michael, I mean, there's a big concern over this number. I think I was reading this morning that debt grows by $96,000 a second. Which is quite breathtaking to think, and
make sure your credit card's not like that.
Yes, exactly. And they were saying that in 1981, under Ronald Reagan, it hit $1 trillion for the first time. So it is an area of big concern, and the bond market seems to be a little bit unhappy about it. Are they? Maybe you could fill us in.
You know what, Robin? How often have we said here that things aren't a problem until they become a problem? You know, and suddenly the market wakes up and looks at something, and I think 40 trillion is it's a headline number. It's a changing number. I mean, it's no different to 39.99 trillion, really. But
Yes.
you have a big figure change, and it focuses people's minds, I think.
Yeah.
But what has been happening in the bond market is that there is this concern around inflation. Obviously, there's a lot of conjecture and discussion about the Federal Reserve under Kevin Walsh, and are they raising rates or are they not, or are they hard on or soft on inflation? You know, there's obviously the Fed, I think, is trying to, let's say, become less transparent. I think they're trying to hold their cards a little bit closer to their chest, maybe under Kevin Walsh. You know, maybe that's the right phrase. Anyway, so the market is uncertain as to where they are going, and what's the consequence of that is that long bonds have been rising. The yields on long bonds, so 30-year bonds are now sort of trading at 5.3% yield, and that's the highest since the financial crisis back in 2007. That's a long time ago. So the 20-year high at the moment. 10-year bonds are at 4.4%, also pretty much higher as the financial crisis. And what then the Treasury announced on Wednesday was that they would double the amount of buybacks at the long end, at the 30-year level, to try and bring those interest rates down, and they would fund it with short-dated debt, you know, where interest rates are lower. Which is cheaper because the sort of curve slopes upwards. So obviously that had the immediate impact of lowering long bond yields by sort of 10 or 15 basis points on the Wednesday. But obviously the issue with raising short-term debt is that rolls over pretty quickly, you know, so you're refinancing that in a year or two's time. But I think the messaging, so that was the immediate market reaction, and then gold prices took off because I suppose there's the implication of that was that, well, where's inflation going, and what's happening in the bond market? You know, 3 days later, bond yields are back where they were before they announced that intervention. And I think the market is just, you know, taking stock of where this debt is. US deficits are running at 6% a year. Obviously, wars are expensive. And yes, they have GDP growth and they have all this investment in AI that's fueling the economy. But the other thing that I think the bond market has got concerned about in the last week or two or three is that you know, we've had the discussion about all the AI companies kind of funding each other. You know, Microsoft buys from Meta or Nvidia, and then they all invest in each other, and it's kind of the circular sort of economy going on. I think that, you know, some of these big, Nvidia went to the bond, quite a lot of the companies have gone to the bond markets to raise a lot of debt, sort of 50, 75 billion at a time. That's a lot of debt. Yeah. And, you know, they're looking at other ways of funding, and I think some of this AI investment is now almost crowding out the government side. Spending. So, you know, whereas before they might be raising it with equity or they might be funding it out of their own free cash flows, now these big companies are saying, okay, well, we actually have to accelerate this capex and we're going to the bond market and there's other debt for investors to buy, and so interest rates are rising a little bit. So there's no doubt that the Treasury is concerned about rising yields, because the more they rise, the more they have to pay on their debt, and obviously at 40 trillion, it's a lot. And I've been doing some work, Robin, on interest payments as a percent of GDP, and they're rising quickly. Now we know where we are as a country in South Africa. Interest payments as a percent of GDP have risen steadily, and it's hard to bring that down under control again. And the US is in the same boat. So I don't think we're at crisis levels in the US, but I think it does reinforce the notion that you want a bit of gold in your portfolio. The dollar's obviously weakened. At some point, Robin, the piper has to be paid. And I'm not sure that that's going to be this year or next year. But, the debt keeps on rising. And at some point, even in the UK, we had the Liz Truss moment where she thought she could do whatever you wanted, and the bond market came in and said, that's not how it works here. And the US is going to face that same moment at some point, and unfortunately, it's actually not good for anything, because you would think, well, then you want to be in equities, but obviously if bond yields really rise, then that's an input into an equity valuation, and that's not helpful, and I suppose if you can then get 5, 6, 7%, 5 or 6% on a long-term bond, well, that's not a bad income return, but it's obviously, we don't like bonds because they don't keep pace with inflation, and it's exactly the same in the US. But anyway, it's just maybe ripples across the surface at the moment, I would call it, but I think it reinforces the notion that you want to be diversified, and it does reinforce the notion that I think the US dollar is vulnerable, because, the US debt, even if you look at Germany's debt, it's sort of 80%, the UK is above 100%, Japan is at 220%. I think bond markets are just around the world saying, there's a lot of debt out there,
And Michael, of course, from a South African point of view, you don't want America to be in a bad space because, they get a sneeze, we get a cold kind of thing. That's always the story. But a weaker dollar leads to an inverse increase in commodity prices. So we've actually seen a stronger rand, better gold and platinum prices, our two biggest exports by value. We kind of beneficiaries a little bit of what's happening.
We are, and obviously we've talked before about mining taxes and how much revenue government is getting from royalties. I think we talked last week or the week before about Valterra's dividend, and just the dividends tax on that for the Treasury is 3 or 4 billion. So obviously these windfall commodity prices do feed through, and the Treasury benefits. And, we've been on a path of obviously this fiscal consolidation for a couple of years. We're running a primary surplus. Hopefully government is going to obviously, when they have the medium-term budget next month or in October, those trends will be confirmed. So our debt should have peaked, and, we've been taking steps for the last 2 or 3 years to try and basically get this sort of under control, And so, yes, I wouldn't say we're out of the woods, but I think in this country, the narrative is very much around bringing down the debt and stabilizing everything. And we've been on that path for a while. The US isn't having that conversation yet. They're not, they passed the big, beautiful bill from Trump. They cut taxes. They do this, they do that. They're not talking about how do we rein in spending and things. And the war's obviously expensive, and it's dragging on for a lot longer than anybody thought.
Awesome.
So,
Well, Michael, we could talk about this all day, but we're out of time. So thank you for giving us that insight. Thank you for joining us. Don't forget to like and subscribe. We'll catch you next time. Bye-bye.